Hey everyone! Welcome to episode 3 of our 10-minute bookkeeping series. Congratulations on making it this far. You're doing great. Today's episode is packed with essential skills that will propel you much further in your bookkeeping journey. We're going to dive into accounts and ledgers, get comfortable with debits and credits, explore double entry accounting, and master the art of posting. By the time you wrap up this episode, you'll see how elegant and brilliant the accounting language is designed. And what's more important, you'll record a transaction like an accountant really does. So fasten your seatbelts and let's get started right away. An account is a financial record, noting the increases and decreases of specific items. If you visualize it, it looks like a T, hence it's called the name T account. At the top of this T, you'll find the account's title. For example, we have an account for cash, which tracks changes in our cash holdings. There's also an account for notes payable, which keeps tabs on notes payable related activities. Accounts are categorized into 6 groups: assets, liabilities, equity, revenues, expenses, and dividends. Think of them as folders for organizing financial information. For example, cash falls under assets, making it an asset account. Notes payable falls under liabilities, designating it as a liability account. This table lists some common account titles we'll delve into later on. However, an entity can create unique accounts tailored to their specific needs. For instance, accounts payable keeps track of what an entity owes to its suppliers. By adding the supplier's name, we can make the account more detailed. This account records how the obligation to its suppliers, Company A, changes. Now, when you bring all the accounts together, you've got a ledger or general ledger. It's like our financial headquarters where we record, organize, and manage all our financial information. Now that we're on familiar ground with accounts and ledgers, let's glide into our next topic, debits and credits. This zone often has folks scratching their heads, so let's demystify it together. As we can see, a T account has 2 sides, left and right. However, we don't just call them left and right. They have special names. The left side is the debit side, labeled as DR, while the right side is the credit side, marked as CR. The difference between total debits and total credits is called the balance of an account. If debits exceed credits, it's a debit balance. If credits exceed debits, it's a credit balance. When they're equal, it's a zero balance. Debit and credit are not just names, they're also verbs in accounting. When you put an amount to the left side, it's called to debit an account. For example, debit cash $300 means you're putting $300 on the left side. On the other hand, when you put an amount to the right side, it's called to credit an account. Credit cash $200 means you're putting $200 to the right side. Quick note, we're just dealing with numbers here. No dollar signs are needed. And remember, in accounting, debit means left and credit means right. They don't signify an increase or decrease on their own. Their meaning for increases or decreases depends on the type of account. For asset accounts, debits mean increases and credits mean decreases. But for liabilities and equity accounts, it's the opposite. Debits mean decreases and credits mean increases. When it comes to revenues, they increase equity. So they follow the same rule as equity, increasing with credits and decreasing with debits. Expenses and dividends, however, reduce equity, so they do the opposite, increase with debits and decrease with credits. All right, time to wrap it up. Assets, expenses, and dividends increase with debits, while liabilities, equity, and revenues increase with credits. And here's a handy memory trick for you. Think of the accounting equation. Assets are on the left side, so they increase with debits. Liabilities and equity are on the right side, so they increase with credits. As for the rules for revenues, expenses, and dividends, they depend on their relationship with equity. Revenues increase equity, so they move in the same direction. Expenses and dividends decrease equity, so they go the opposite way. Armed with the understanding of debits and credits, let's now delve into how accountants truly record a transaction. After analyzing a transaction, accountants will make journal entries to record them using double entry accounting. Double entry accounting is a method where every transaction involves at least 2 accounts, one debit and one credit. And the sum of debits always equals the sum of credits. Sounds complicated? Think of it as a brilliant way to maintain balance in the accounting equation. To keep things balanced, these 4 situations cover all the effects a transaction can have. If you replace the increase and decrease with debit and credit, you'll always have a debit and a credit, with their amounts matching. Remember how we analyzed Red Apple's transactions in episode 2? If you haven't caught it, go watch it now to ensure you're in the loop for some crucial details. And now let's record these transactions in double entry accounting. On January 2nd, Red Apple gets $5,000 from its owner, Amy. This transaction affects 2 accounts, cash and capital. Cash falls under assets, so when it increases, we debit cash. Capital belongs to equity, so when it goes up, we credit capital. Traditionally, we list the debit first and neatly indent the credit by 2 spaces, creating a visually balanced entry. Moving on to January 3rd, Red Apple borrows a $3,000 from a bank, boosting both cash and the note payable account. Similarly, we debit cash as it's an asset, and we credit note payable since it's a liability account. And now, here's your challenge. Pause the video and try recording the remaining transactions with double entry accounting. Welcome back. Here are the answers. Did you nail it? To make journal entries more organized, we can craft a table with the transaction date, a brief description, the affected account titles, and their dollar amounts. This table is the journal for Red Apple. Congratulations! You've unlocked the technique of making journal entries using the powerful method of double entry accounting. It's a crucial step in recording financial transactions, and we'll be using it throughout our journey. All right, now it's time to hit the last lap of this episode. After making journal entries, the next step is posting. When we talk about posting, we mean putting the numbers into the right accounts based on the journal entries. Now, you might think posting is just copying, but it's a crucial part of bookkeeping. Without posting, we can't figure out the new balances of accounts, which are essential for creating financial statements. Imagine this. We have the Smart Consult, a consulting firm. At the start of an accounting period, some of their accounts look like this. Cash begins at $5,000 and notes payable at $2,000. Revenue and expense are at 0 as they only record changes during the period. During the period, the company borrows $5,000 from the bank, signing a note. This increases cash and notes payable by $5,000 each. So we debit cash and credit notes payable. Now, we can post this journal entry to the cash account and note payable account. Your challenge? Record these transactions in journal entries and post them to the ledger. Pause the video and give it a shot. Welcome back. Did you nail it? Let's walk through this together. For transaction 2, both cash and revenue increases by $5,000. So we debit cash and credit revenue. Now we can post them to the ledger. Transaction 3 decreases cash by $2,000 and increases expense by $2,000. So we debit expense and credit cash, and we post these to the ledger. At the end of the accounting period, we tally up the total debits for each account, and then add up the total credits. The difference between the total debits and credits becomes the new balances. And all these balances are what you'll see on the financial statements. Now, we've covered everything about how to record a transaction, from analyzing transactions to making journal entries, and posting them to the ledger. You're now ready to record a transaction like a pro. Take a moment to give yourself a well-deserved pat on the back for your hard work, and dive into the exercises to reinforce your skills. In the next episode, we're setting sail into the fascinating world of revenues. So stay tuned for more bookkeeping adventures.